Next up, the Iran conflict continues to trigger fresh turbulence across global financial markets. Bond markets are witnessing a massive sell-off, with US Treasury yields surging to multi-year highs. Even as stock markets remain relatively resilient on strong corporate earnings and the AI boom as well, analysts warn that a prolonged energy shock could reshape the global economic outlook. Here's a detailed report. Take a look.
The global bond market sell-off intensified as the United States and Iran remained far apart on a deal to end the conflict. Investor concerns over prolonged disruptions to oil shipments pushed crude prices sharply higher, reigniting fears of persistent inflation across major economies. The impact was visible across global debt markets. In the U.S., 30-year Treasury yield crossed 5.15%, its highest level in years. Japan's 10-year government bond yield jumped to levels last seen in 1996, while bond markets in Europe, Australia and New Zealand also came under pressure. Markets are now rapidly repricing expectations for global interest rates, as investors fear the elevated energy prices could trigger another wave of inflation and force central banks to keep rates higher for longer. To understand the current market turmoil, it is important to understand what the bond market actually is. Now, bonds are essentially loans. Governments issue bonds to borrow money from investors and in return promise to pay regular interest along with repayment after a fixed period. When investors begin selling bonds aggressively, bond prices fall and yields rise. Yields are effectively the interest rates governments must offer to attract buyers. So a bond market sell-off means borrowing costs across the economy are increasing. Governments, companies, and even consumers can end up paying more for loans, mortgages, and business financing. The latest market turbulence reflects growing fears that the conflict is evolving into a broader economic shock, and those fears have already altered market expectations. Investors who were previously betting on interest rate cuts from the U.S. Federal Reserve are now pricing in the possibility of fresh rate hikes. The European Central Bank and the Bank of England are also expected to maintain tighter monetary policies amid rising inflation concerns.
The war in the Middle East has led to a sharp increase in energy prices, pushing up inflation and weighing on economic sentiment. The implications of the war for medium-term inflation and economic activity will depend on the intensity, the duration of the energy price shock, and the scale of its indirect and second-round effects.
Despite the sharp rise in bond yields and growing inflation fears, equity markets have remained relatively resilient so far. The S&P 500 has rebounded strongly from its March lows as investors continue to back major technology and AI-linked companies. However, market strategies warn that rising bond yields could eventually pressure stock valuations. Several investors now warn that if oil prices remain above $100 for an extended period, the global economy could enter a new inflation regime marked by persistently high energy costs, elevated interest rates, and slower growth. Business Bureau Report, WION World is One.